Welcome back to The Deep Dive. We're here to cut through the noise on corporate events and give you the insight you need fast.
Today we're digging into Leonardo DRS. They just had their Q3 fiscal 2025 earnings call. That was October 29th.
Right. And this one's fascinating because on paper, DRS looked great. I mean, they're a big defense electronics name, solid market.
Exactly. They delivered strong numbers, huge bookings, beat estimates, but the market didn't like it. The stock dropped about 5% right after.
So that's our mission today. Figure out why a beaten book quarter led to, well, a sell-off.
Let's start with those numbers, the ones that look so good initially.
Okay. So for you, the investor looking at the headlines, non-GAAP adjusted EPS, it came in at $0.29. That was a penny better than the $0.28 consensus. A slight beat, but a beat.
And revenue was where they really shone. And $960 million reported. The street was looking for something like $924 to $934 million. So a comfortable beat there.
Yeah, that's what, 18% growth year over year on the top line? Pretty strong.
Very strong. Yeah. And then you look at the bookings. That's where you see the future pipeline, right?
Absolutely. Bookings were exceptional, $1.3 billion. That gives them a book-to-bill ratio of 1.4x. Massive.
Which means they booked way more new business than they billed in the quarter. Always a good sign.
And it pushed their total backlog to a new record, $8.9 billion. That's up 8% year over year.
So you've got years of work lined up, double-digit revenue growth, alignment with DoD spending. It all sounds great.
It does, but like you said, the market just shrugged it off. Or worse, actually.
Right. Despite the beats, the focus immediately snapped away from that growth story. It landed squarely on profitability, specifically the margins.
Okay, let's unpack that then. The adjusted EBITDA number was $117 million. Now that's up 17% in dollar terms year over year, which sounds good.
But it's about the percentage, the margin itself. It actually compressed a little bit. Came in at 12.2%. That's down 10 basis points from last year.
Only 10 basis points, but down is down, especially when revenue is growing that fast.
Exactly. That's the crux of it. The market sees revenue up 18%, but EBITDA margin slightly down. That signals a lack of operating leverage.
Meaning the costs are growing just as fast or maybe even faster than the revenue?
Pretty much. Or it means the mix of business is less profitable, or R&D spending is up. Something is eating into those extra revenue dollars. It cools the enthusiasm fast.
Okay, so digging into the segments should give us some clues, right?
It does. It was really a tale of two segments. First, you had Integrated Mission Systems, or IMS. That was the star.
Okay.
IMS revenue shot up 34%. And crucially, their margins expanded by 120 basis points.
Wow, okay. What drove that strength in IMS?
Primarily two things. Their counter-UAS systems, anti-drone tech, which is obviously huge right now, and their electric power and propulsion work, especially for the Columbia-class submarines.
Got it. So IMS looks great. What about the other side?
That would be advanced sensing and computing, or ASC. And that's where the margin pressure really showed up. ASC margins contracted by 100 basis points.
Okay, a full percentage point drop there. Why? What did management say?
They pointed to two main things. One, higher spending on internal research and development, IRD. And two, what they called less favorable program mix and some operational execution issues.
Let's talk about that IRD spend. It's a strategic choice, but it costs money now.
Right. They were pretty clear that IRAD will stay elevated around the mid 3% of revenue mark. Their argument is they need to spend this to innovate, stay agile, and bring mature tech to new competitions.
Especially in areas like counter-UAS and this new push into naval computing they mentioned.
Exactly. They see big opportunities there, but you need the tech ready to go. The question for you as an investor is always, is this truly strategic growth spending, or is it just the cost of staying in the game in defense tech?
That's a good question. And what about the operational issues? Did they give specifics?
The big one they called out was germanium supply. That's a critical material for their advanced infrared sensors, which sits in that ASC segment.
Ah, okay. So supply chain issues hitting margins. Germanium is pretty specialized, isn't it? And often sourced from places like China.
Precisely. It's expensive, the supply can be volatile, and yes, there's geopolitical risk tied to sourcing. Management said they're using buffer stock, trying recycling initiatives.
Okay.
But the real long-term fix is diversifying the supply base away from China. That's crucial for stability in 2026 and beyond. But doing that isn't cheap or easy. It can definitely pressure margins in the near term.
Makes sense. So despite those headwinds, the bookings show the strategy is resonating, right?
Yeah.
Particularly counter-UAS.
Definitely. They booked over $250 million just in counter-UAS this quarter. And they mentioned it's now a significant part of the business, like 18% to 20% of revenue. Plus, they emphasize their systems are battle tested, which is a big deal for customers.
And you mentioned naval computing innovation?
Yeah, they highlighted some new products like Thor, which sounds like a networked computing system for ships, and something called the Sage Core operating system. The idea seems to be pushing AI and computing power right to the edge on the ships or vehicles themselves. It aligns with big Army initiatives like NGC-2, Next Gen Command and Control. It's about future-proofing.
And we shouldn't forget electric power and propulsion. The Columbia-class submarine work is foundational.
Absolutely. Consistent performance there is key. And they're trying to leverage that tech for other ship classes, too. That's a potential multi-decade growth story if they can pull it off.
Okay, so strong demand, key tech areas. But then we get to guidance. And this seems to be where the market really got hung up.
Yeah, this is where the optimism kind of hit a wall. They did raise the full year 2025 revenue guidance, but only slightly. Narrowed it to $3.555 billion.
Okay, a raise is a raise, but maybe not by much.
Right. But the killer was the adjusted EBITDA guidance. They left it completely unchanged. $437 million to $453 million.
So more revenue expected, but no more profit expected at the midpoint.
Exactly. That screams margin pressure. It tells you all that extra revenue they now expect to bring in, it's eaten up by higher IRA, those mix issues, the germanium cost, whatever. No flow through to the bottom line.
They did lift the adjusted EPS guidance midpoint slightly, though.
They did, to $1.07 at $1.12. But they explicitly said that was due to a lower expected tax rate down to 18%, not because of better operating margins.
Okay, so financial engineering, not operational improvement, driving that EPS bump. I can see why the market wasn't impressed.
It just reinforces that narrative. Growth is there, but converting it to profit is proving tricky right now. And then you layer on a leadership change.
Right. CEO Bill Lynn is retiring January 1st, 2026. COO John Baloney steps in.
Lynn's well regarded. A transition always adds a bit of uncertainty, especially when you're handing over the reins amid these margin questions.
Yeah, inheriting flat EBITDA guidance and supply issues isn't exactly the easiest start, is it?
Not ideal. Investors like clarity. On the capital allocation front, pretty standard stuff. $1.09 dividend declared. They bought back about $10 million in shares.
And they made that small strategic investment too, right, in Hoverfly.
Yeah, up their stake to about 25% with another $15 million. Hoverfly does tethered drones, basically drones on a leash for continuous aerial surveillance or sensing. Fits right into their counter-UAS and sensing portfolio.
Makes sense strategically.
Yeah.
One last thing from the call, any macro concerns?
They did mention the U.S. government shutdown risk. At the time of the call, impacts were moderate, but they warned that if it dragged on deep into November, you could start seeing delays in contract awards and eventually payments. Just something to watch.
Okay. So strong growth, clear alignment with defense priorities, but very real near-term margin headwinds and flat profit guidance. That sets the stage.
Exactly. Which brings us nicely to our next segment.
All right. It's time for, this is not financial advice, and we really have to stress this part. This is purely for discussion, maybe entertainment. Don't base any trades on what you hear.
Absolutely. We're just going to float an idea, maybe an outrageous but plausible one, designed to play on the very disconnect we've been talking about, this timing issue with the margins.
Okay, pitch it. The market's selling DRS now because of the immediate problems, right? Flat EBITDA guidance, the IRA spend dragging, the germanium issue.
Right. Near-term pain. But management actually laid out some specific longer-term reasons why margins should improve significantly. These aren't vague hopes. They're tied to known program timelines.
Okay, like what?
The big one is the Columbia-class program. They've basically signaled that the second submarine ship set they're delivering now has lower margins, kind of like an initial production run. Most of that lower margin revenue will be finished off the books after 2025.
So starting in 2026, the subsequent Columbia ship set should come in at better, more normalized margins.
That's the expectation. It should provide a natural lift to margins in the electric power and propulsion segment, just based on the program's life cycle moving forward.
Okay, that's one catalyst, but it's still a little ways off.
True. But there's another potentially bigger one. They expect a significant margin benefit starting in 2027.
2027. What happens then?
Their new big production facility in South Carolina is supposed to be fully online. State-of-the-art, built for efficiency and scale, particularly for that power and propulsion work. That should drive major cost savings and throughput improvements.
Okay, so you have Columbia margins improving maybe in 26 and then a big facility boost in 27. The market's focused on 25 guidance right now.
Exactly. So the outrageous but plausible trade idea. You ignore the near-term noise, You bet on those future margin catalysts. You could consider a long position in DRS, but specifically using far-dated call options.
Like way out, January 2027 expiration, maybe?
Something like that.
Yeah.
You're essentially betting that the market is overly focused on the next few quarters' margin flatness, and you want to capture the potential re-rating of the stock when those Columbia and South Carolina facility benefits actually start hitting the P&L in 26 and 27.
So you're trading the shift from today's growth with messy margin story to a future profitable scale story, using time as your edge.
That's the concept. It hedges the current pessimism by focusing purely on those defined future inflection points. Again, purely hypothetical.
Got it. Okay, so wrapping up the call overall.
DRS showed strong demand, great bookings, proving they are in the right markets. Counter-UAS, naval tech, electric power, record backlog of $8.9 billion. Can't argue with that. But the big question mark, the reason for the stock drop, is whether they can turn that huge backlog into profitable growth anytime soon. The flat EBITDA guidance left that wide open.
So for you, the listener, it's not just about watching the contract wins anymore.
No. The key thing to track over the next, say, 2 quarters is any commentary about R&D payback and margin trajectory. When does that IRS spend start translating into higher margin contracts? When do they see the germanium situation stabilizing? That's what the market needs clarity on.
Which brings up a really interesting final thought, doesn't it?
Yeah, it makes you think about defense investing more broadly. With technology moving so fast in areas like AI, drones, cyber, what is the right level of R&D spending for these big defense companies?
How much do they need to spend just to keep up versus spending for real breakthroughs? And how long should you, as an investor, wait for that spending to show up as better margins?
That balance, that timing. That's really the core of the challenge for DRS and many others in the sector right now.
A crucial question indeed. Okay, that's our deep dive for today. Thanks for tuning in.
We'll catch you next time.